Hey, today we are looking at candlestick patterns. We will start with the basics of what candlesticks are and how to read them, and go over basic candlestick patterns and how to apply them. This video is part of my 1.5 hour long price action trading video where I cover all the basics regarding technical analysis and price action trading. There I cover everything from setting up a free Tradingview account over candlestick patterns, chart patterns, trend lines, support and resistance, you name it. If you'd like to go a bit more in depth and bring some time with you, definitely check it out. I'll leave a link in the description. But now let's have a go at candlestick patterns. First of all, what is a candlestick? A candlestick is a visual representation of price and displays the high, low, and closing prices of a security or commodity for a specific time frame. There's a green candle that represents price going up and a red candle which represents price going down. Both candles have a body and can have an upper and lower wick. The opening price on the green candle starts at the bottom of the candle's body here, and the closing price is here at the top of the candle's body. The highest price during this time frame, let's say this is a daily candle, is on the top of the upper wick, and the lowest price during this time frame is at the bottom of the lower wick. Right? Regarding opening and closing price, the opposite is true for the red candle. The opening price starts here and the closing price down here. Again, highest price is reflected here at the top of the upper wick and the lowest price down here below. One important thing to mention is that one candlestick on its own doesn't tell you really where price is likely to go, right? But a candle pattern in combination with key areas of support and resistance can give you a pretty good idea. Now let's take a look at some basic candlestick patterns. Here we have a shrinking candlestick pattern in an uptrend. This means that there are 3 or more candles that are continuously shrinking and where each candle is smaller than the previous one. In an uptrend, this shows a loss of momentum where buyers are less and less in control, and if close to a key resistance level like here, it can be an indicator of a potential reversal to the downside. Here on the right side we have the same pattern but in bearish. Again, this is a downtrend and each candle is smaller than the previous one, and if combined or near a area of key support, this can be also an indicator for potential trend reversal. Next we have a growing candlestick pattern. This pattern shows 3 or more candlesticks where each one is bigger than the previous one, the exact opposite of the shrinking candle pattern. And here, building after a downtrend and coming from a key resistance level here, this can be seen as a trend reversal confirmation. If, on the other hand, this candle formation forms after an uptrend at a key resistance level, this can be seen as a reversal confirmation pattern to the downside. Here we have the doji candle, and the doji candle has a very small body, as we can observe here. And it shows us that the opening and closing price are basically identical. And depending on the length of the wicks, we can see how much buyers and sellers were fighting for the price, which eventually ended up in a draw, right? So we have the opening price here and the closing price basically at the same level. And in the meantime, buyers and sellers were fighting. It represents an indecision of where price should go and is often an indicator for a reversal as the momentum has been lost, as here in an uptrend, right? Combined with a key resistance level. And this can be an indicator for a reversal. Here is the doji candle, a bullish doji candle, which can form here on a key support level. And coming from a downtrend is exactly the same, an indecision in price between buyers and sellers, a loss of momentum, and can be a possible sign for a reversal. Next, we have a momentum candle, but this bar here in particular is the exact opposite of the doji bar, where you have a very long candle with no wicks. And yeah, here in this case, they represent a momentum candle. And if they are coming from an uptrend and forming at a key resistance level, this would be an indicator for a possible trend change, as there's a lot of momentum to the downside here. Here we have after a downtrend, we have this bullish momentum candle forming, and this is, if forming at a key resistance level, also an indicator for a possible trend change. The hanging man. The hanging man is a bearish candlestick pattern that forms at the end of an uptrend. The pattern is created when open, high, and close are roughly equal, right? This is open, close, and the high. And the low of the day is significantly lower than the other three price points. The long lower wick indicates the sellers were able to push prices lower, but buyers were able to step in and push prices back up to close near the highs. The hanging man is a bearish reversal pattern, and it should be treated as such. While it can be a powerful signal, it is best used in conjunction with other technical indicators to confirm reversal. The hammer. The hammer is basically the same candle as the hanging man, with the difference that it forms at the end of a downtrend and indicates a possible bullish reversal. Here we have two engulfing candle patterns. The first one is a bearish one, and the second one here is a bullish one. And the bullish engulfing candle pattern is a two-stick candle pattern that is used to signal a potential reversal in a market. The first candlestick is typically a small bearish candlestick, this one here, and the second one is a large bullish one. And it's called an engulfing candle because this bullish candle is engulfing the previous bearish candle's body completely. Right? The bearish engulfing pattern is opposite of the bullish one. The bearish one is also a two candlestick pattern that is used to signal a potential reversal as well. And the first candlestick in the pattern is typically a small bullish candlestick, and the second one in the pattern is a large bearish one. That completely, here again, it completely engulfs the previous bullish candle's body. Yep, up to the next one. This one is is a candle pattern with multiple long wicks, and it shows a reaction to a certain price level. Those are basically multiple failed attempts to break through this price level, this key resistance level. It came near close here, it touched here, temporarily got through here and here as well. So this means that there's a reaction to this price level and can be a great indicator for a reversal. Here on the support level, the same, there are several long wick candles forming and which failed to break through this level, and here again can be a great indicator for a reversal. Again, one candlestick on its own doesn't tell you really where prices are likely to go, but a candlestick pattern in combination with key areas of support and resistance can give you a pretty good idea. Well, I think this is it regarding basic candlestick patterns. There are of course more patterns, but I think I've touched on the most basic ones. If you think I've missed something essential, or if I've got something completely wrong, please let me know in the comments down below. It's much appreciated. Thanks.